Hey, it's Navi Dowty here in the Chicago area, in the Midwest, in the great United States. This week in our tax tips, let's talk about a hidden tax that you can avoid paying if you do proper planning. People who earn more than $91,000 a year or $182,000 for joint filers and who are in Medicare Part B or Medicare Part D or both will face additional premiums called Income-Related Monthly Adjusted Amount, or IRMA. IRMA surcharges, which is a replacement word for a tax, are based on the income earned 2 years prior to the coverage year. A client enrolling in Medicare in 2022 would pay an IRMA surcharge based on their 2020 tax return. Generally, there are two types of people who pay IRMA surcharges: those who might be affected and those who will always be affected. Because it is income-based, people with an unusual income event may only be affected once, while people with higher incomes may always be affected. The surcharge assessed depends on on a special modified adjusted gross income, MAGI calculation, different from that used to calculate income tax. To oversimplify a little bit, the surcharges apply to single filers earning over $91,000 MAGI and joint filers earning over $182,000 on a sliding scale, with a maximum surcharge assessed on single incomes over $500,000 and joint incomes over $750,000. Doesn't affect that many people. Many types of one-time income events can trigger these surcharges, however, including withdrawals from retirement accounts, inheriting IRAs, cashing in some MEC life insurance policies, selling stocks and bonds, or flow through from mutual fund, and more. People who simply have large pensions or just large estates with high incomes, business owners that work while on Medicare, and trust beneficiaries would likely always owe the additional surcharges, would likely be less surprised by them as an annual event. People with a one-time or occasional spikes in income may be able to tax plan the surcharge away if they're paying attention by harvesting tax credits, making charitable donations, advancing depreciation on real estate or business assets, or using other planning tools. The critical issue is awareness. Typically, the only people who will be aware of the surcharge in time to take action to lessen their income and undo the surcharge are people who use tax planners and not just tax preparers. Tax planners will usually draft a tax return in the fall with each client, and they would see the surcharge income issue and discuss countermeasures to avoid IRMA. Tax preparers usually don't receive paperwork from the client until the next year, sometimes moments before it's due, when it is too late to fix it. If your income is, or might be this year, at or near the income thresholds above, then contact a tax planner and start a conversation. I'm Navi Dowty, and remember, financial fitness can be beneficial to your wealth.